Hi, Professor Christensen. I'm here to talk about case study 2-3 on the tax return, broadcasting to you from Panama City, Panama, and that is a box spring behind me. This is the best setup I have for this presentation, but that's all right. So I have a lot to cover. I'm going to quickly summarize the case study. Basically, Brenda Sells repairs a tax return for Harry Cohn, and her manager, Vincent Dim, calls her into his office to tell her that the client isn't happy because she reported his lottery winnings as revenue. This tax law states that this is how you have to report lottery winnings, but since it isn't financially beneficial for the client, her manager suggests that she remove that from the tax return, and he uses 3 rationalizations, which we'll talk about later. So, Brenda's given 1 day to think about it, and she's encouraged to remove it from the tax return, but Vincent invites her to think about it for a day and follow up with her the next day. So we're going to use 3 different questions from the textbook to decide what the best course of action is for her. First, we're going to use Kohlberg's 6 stages of moral development. Then we're going to address the rationalizations presented by her manager, and finally we'll plan for similar dilemmas in the future. So Kohlberg's theory of moral development has 3 stages: pre-conventional, conventional, and post-conventional. I'm going to have to go through these pretty quickly because I have a time limit, but stage 1 talks about avoiding consequences, avoiding punishment, and obeying rules. So in this case, she's going to side with the suggestion of her manager, and she's going to choose to remove this from the tax return because she wants to avoid punishments. Secondly, stage 2 talks about satisfying one's own needs. In order to satisfy her own needs, she'll again choose to leave it off the tax return because this will benefit her by helping her gain favor within her firm, which could lead down the line to raises, promotions, and things like that. Finally, we're going to enter the conventional level with stage 3, which is fairness to others. In this case, the individual is motivated by rules but seeks to do what is the best perceived within groups that she's a part of. So it will benefit the firm by helping facilitate return business from this important client if she respects his wishes. So in this case, she's going to choose to remove it as well, so that it will benefit her firm, which is why the manager wants her to do it. Finally, stage 4, she's going to have to respect laws, which say that tax law says that she has to report it as revenue, so she will leave it on the tax return. Stage 5 is the social contract, in which the individual is motivated by upholding the basic rights, values, and legal contracts of society. It talks about legal and moral points of view. So in this case, she's going to recognize that following laws help to benefit society, so she will also choose to remove it from the tax return. And finally, stage 6 talks about universal ethical principles, where she'll have to respect universal ethical principles such as justice, which will make her more inclined to leave or to report this on the tax return. So the rationalizations and arguments, there are 3 that her manager presents. Number 1, that it's a one-time request. Number 2, other employees are doing the same thing. And rationalization number 3 is loyalty to the firm. I've got a funny comic here, but I don't have time to address it right now. Rationalization 1 is that it's a one-time request. What we learned from the case study written by some of our SEU professors is that if you make small unethical decisions, you're more likely to do it again down the line. I can share some examples of that, but I don't have time. So basically, if she does this now, she's more likely to do more unethical things later during her career. So this rationalization is not very accurate. Rationalization number 2, other employees are doing it. I have the example from Webcom, which is one of the most famous accounting scandals in history. Betty Vinson versus Cynthia Cooper. Betty Vinson, they had the same job, same responsibilities, Betty Vinson chose to follow what her superiors told her because she was afraid of losing her job, and she ended up in jail. Cynthia Cooper was a whistleblower. She found out that they were acting unethically, and she reported it, and she was rewarded for that. So rationalization 3 is loyalty to the firm. I wanted to talk about Badaracco's defining moments. He talks about 4 questions to ask yourself when faced with the right versus right dilemma. I'd like to go through each of these questions, but I'm running out of time. But if we analyze it from the perspective of a right versus right dilemma, also known as a dirty hands problem, we'll also come to the same conclusion, that she should leave it off of, or that she should report it on the tax return. So planning for similar situations in the future. Basically, in the case study, the question is, now that Brenda's suggesting that Brenda decided to follow her manager's request, the following year he asks for a similar request related to lottery winnings, and the question is, what should she do in this case? I have a story to present that's also from the Small Things, Big Things, Small Things, First Things case study. Related to newspapers. Basically, the point of the story is that when you act ethically and with integrity, others will follow suit. So if she chooses the first year to act with integrity and to act ethically, the following year, things like others in the firm will act in the same way. So it benefits everyone, to be honest. So that's all I have today. I tried to keep it as short as possible, but there was so much to cover. I hope you enjoyed my presentation, and I hope you have a good day.